Look closely at a physical coin. It feels like wealth, but it is a physical token representing something invisible. Money is an information system. Before standardized currency, human trade relied on barter, which is crippled by a mathematical bottleneck known as the double coincidence of wants. If you have wheat and need shoes, you must find a cobbler who happens to want exactly the amount of wheat you hold. To solve this, a modern economy establishes a currency satisfying three requirements. First, a medium of exchange. Second, a reliable store of value. And third, a precise unit of account, allowing us to measure a tractor against a loaf of bread using the same metric. By acting as a standardized unit of account, this information system allows a sovereign nation to aggregate its total domestic output and ultimately translate that value onto the global stage. When we trade across borders, we encounter the nominal exchange rate. This is the raw, unadjusted market conversion rate on a ticker, telling you exactly how many rupees you need to buy $1 today. But that raw number is deceptive. To find true purchasing power, we use purchasing power parity. If a burger is 35 rupees in India and 50 cents in the US, the PPP exchange rate is 70 rupees per dollar. The real exchange rate is the nominal rate divided by PPP. This math centers on the threshold of 1. An RER below this mark indicates that Indian products cost less than their international equivalents, a direct signal that India is highly competitive on the global export market. Because India trades with dozens of countries, measuring against the US dollar alone isn't enough. The nominal effective exchange rate, or NER, solves this by measuring the rupee against a mathematically weighted basket of multiple trading partners. Finally, we have the real effective exchange rate, or RER. This chart illustrates what happens when we adjust the NER for inflation. Notice how the REER line detaches and drops when domestic inflation runs higher than inflation in partner countries. Relying on raw dollar exchange rates provides an incomplete picture. Calculating the RER and REER is the only way to accurately measure India's true trade competitiveness. To build an economy, that money has to move from those who save to those who build. It moves via a security, a tradable financial asset that represents a legal claim on future cash flows. This matrix maps the landscape of these instruments. The top half belongs to government securities, carrying sovereign backing. In the top left quadrant, the short-term money market, are treasury bills. The government issues these strictly for 91, 182, or 364 days to manage immediate liquidity. A common trap on civil service exams is the interest structure of T-bills. They are zero-coupon bonds. They pay no explicit interest rate, but are instead sold at a discount and redeemed at full face value. For borrowing periods exceeding 1 year, the government shifts to the top right quadrant of the capital market. These are dated securities, paying interest over long durations. Dropping to the bottom right quadrant, the private sector issues its own long-term equivalent, corporate bonds. Because private companies lack the taxing power of a sovereign state, their bonds carry an inherent risk of default. To attract capital away from ultra-safe government debt, these corporations must offer higher percentage yields. Every security in this matrix is defined by two variables: who issues it and how long it takes to mature. Those two factors completely dictate the risk profile and potential reward for the investor.
These securities cannot be traded informally. They require heavily regulated, centralized arenas to ensure transparency and trust. The first arena is the money market. This is the financial ecosystem built strictly for managing short-term liquidity, dealing exclusively in instruments that mature in under 365 days. The second arena is the capital market. This is where structural investment and long-term wealth creation happen, trading assets that take longer than a year to mature. Jurisdiction over these arenas is strictly divided. The Reserve Bank of India acts as the apex regulator for the money market, managing immediate cash flow. Conversely, the Securities and Exchange Board of India, or SEBI, holds regulatory authority over the capital market. Access to these capital markets is restricted by corporate structure. A public limited company can issue securities to retail investors, while a private limited company is legally barred from doing so. In exam scenarios, clearly distinguishing between a short-term RBI transaction and a long-term SEBI-regulated issuance is the fastest way to eliminate incorrect options. Before the RBI can deploy monetary policy, it has to measure exactly how much money is available, and that measurement starts at the household level, based on how the public chooses to store its wealth. The first category is demand deposits, consisting primarily of current and savings accounts. As the name implies, account holders can demand their funds immediately. These accounts provide extreme liquidity. You can swipe a debit card anytime, but in exchange for that instant access, banks offer minimal interest returns. To earn higher yields, depositors use time deposits, like fixed and recurring deposits. Here, you legally lock your capital away for a fixed period, relinquishing immediate liquidity in exchange for a higher interest rate. The collective decision made by millions of individuals, weighing instant access against higher interest, dictates the volume and velocity of usable money circulating through the national economy. The RBI categorizes this total volume of money into specific aggregates based on varying degrees of liquidity. We can visualize this methodology as an inverted funnel, with the most liquid assets at the top. At the very bottom sits M0, or reserve money. This is the foundational base, physical currency in circulation, plus the deposits held by bankers at the RBI. Jumping to the widest, most liquid layer at the top, we find M1, or narrow money. This combines the currency held by the public with their highly liquid demand deposits. Just below that is M2. This expands the M1 definition slightly to include savings deposits held within post office banks. N3, or broad money, serves as the primary metric the RBI monitors to gauge the overall health of the economy by adding all locked-in time deposits to the M1 base. Finally, M4 sets at the narrowest point, representing M3 plus the totality of all post office deposits. This structure reveals how a drop in immediate liquidity creates structural strength. When a household moves cash from a savings account in M1 into a fixed deposit in M3, they arm commercial banks with the stable capital needed to fund long-term corporate bonds and government securities. Interpreting the flow of capital from highly liquid M1 into structural M3 provides the necessary data to project inflation patterns, interest rate shifts, and the trajectory of India's GDP growth.